recording as well, even though Twitch is going to record it for us. But we're going to work out all these kinks, and it's going to be a great time. But before we get started, because of the world that we live in, just have to make everyone aware that this broadcast is for information and education purposes only. We're going to talk about crypto markets. We're going to talk about macro, the micro. We're going to look at some charts. We might hypothesize about trading. We might talk about which exchanges might be viable, but at the end of the day, please remember, it's up to you to do your own research. You got to be diligent, and you got to look out for yourself. And nothing that we say should be construed as financial advice or trading advice. There, I said it. Let's let's get into talking a little bit about what's coming down the pipe this week. So we'll look at a calendar, an economic calendar, and talk a little bit about some cool sites that we check, and we'll get into that. And so looking, and Josh, you can see this week's calendar on the screen on your end, right?
I can, yes. So kind
Okay,
of walk us
good
through
deal.
what we're looking at here.
Yeah, so for the coming week, we're looking at a website called tradingeconomics.com. Gotten a lot of mileage out of this in my illustrious career, quote unquote, of being exposed to financial markets, both as a retail trader and then also as a fly on the wall inside of a family office. And this was a tool that we used regularly. And in a nutshell, there's a good saying that if you don't do macro, then macro will do you. And if you've been in financial markets for any amount of time, you've probably heard that. If you watch CNBC, you've heard that 15 million times. Those guys and gals love to say it. Anyway, what we're trying to get an understanding of is that this week there are on a schedule. Thankfully, these things are all scheduled ahead of time. So all it takes is a little elbow grease and a little diligence to go and look and see who's talking, where are they talking, what are they talking about, and try to understand what the macro headwinds, or on the flip side of that, what the macro tailwinds might be, and how they affect the markets that you're looking at. In this case, we're looking at crypto. So let's dive in. So look like today's the 6th of Feb, 2023. In the U.S., in this particular interface, we're looking at like G20. It's basically G20, or majors, as Trading Economics calls it. We're looking at majors. I like to look at it in aggregate to start, because it gives you an idea if you were trading foreign spot currency or non-deliverable forwards or something like that, or interest rate futures, you would want to understand how the pound, here's the BOE dude from what's his last name, man's giving a speech today, and that may or may not move the market. Anyway, looks like nothing major coming down the pipe for the U.S. today. Lots of action in the ROW, rest of the world, we used to call it. Tomorrow is really, I think, and I'll pause here for a second, because tomorrow's the big one, and it looks like we have a couple of Fed talking heads. Well, a couple things: the trade numbers and how that affects the government, and how they're going to, how that's going to affect future debt ceiling crap that we'll have to deal with. And then really, I want to highlight that it's Powell, the biggest name from the Fed bench, if you will, is Powell's going to talk tomorrow. And I think we'll get into this a little bit later, but I think there's probably like a lot of you could probably say a lot of the move in Bitcoin or others that have risen dramatically this last several weeks are, have priced in up to this point what they think Powell's going to say. And I think and correct me if I'm wrong and tell me what you think here, Josh, if they're looking for more guidance around whether or not or how aggressive rate hikes are going to be into the rest of the year.
Yeah, I would agree. I think what these markets kind of want is, markets don't like uncertainty. And so when you have, the Fed who's raised rates, and we can talk about this too, the rate of change versus the percentage rate, right? Like what they've done.
Oh, I think we might have lost you there. Crap. while we wait to get Josh back. One other
We
thing
follow as
to,
crypto traders and crypto investors, maybe we can take a step back and talk about maybe why we even care about this stuff. Because when I first got into crypto 5 or 6 years ago, we did not give a shit about any of this stuff. Like it wasn't on the radar. It didn't matter. It might have mattered. We just didn't know it. As crypto has grown and become more relevant to traditional finance, these markets have kind of traded in line with some of these news. And that's why we're going over this, because it's important to understand uh, the direction of the markets and what can move the markets up or down. And right now, it's definitely been the Fed. So that's kind of why we go over this, and why we start at the macro, right? And then Ted, if you want to add some color to that as to why that's important for us, that'd be great.
yeah, I think the way you articulated it was pretty, or I agree with how you've articulated that. In the past, the crypto markets didn't really care, and there's the I guess the biggest or the most poignant thing to me when thinking about why are we talking about interest rates, and I think that has to do with the fact or the level of involvement of uh, I'll try to concisely or very concisely convey like this idea of like institutional investors or not institutional money, I should say. And what I mean by that is Wall Street pe- people who would consider themselves to be Wall Street types or private equity hedge funds. Uh, where I'm going with this is that they are all heavily regulated by the federal government, and as a result, when the federal government does anything or says anything, it greatly influences the way that they allocate capital firepower in financial markets for the express purpose of making money. And in the U.S., when you're making money, you're settling in U.S. dollars, and that's what they care about, quite frankly, because this is how they make their living. They get paid in dollars, and last but not least, our tax liabilities are all denominated in U.S. dollars and can only be settled in U.S. dollars at the federal level today. Maybe that'll change someday, but I think that is a fair way. It may be a very narrow way to look at it. Maybe there's more that I don't understand because I'm just one person, and there's literally hundreds of thousands of these entities out there, and they've spent their careers in finance and understand things at a level that I don't today. But I think, in summary, is that the institutional money, the heavily regulated entities, and the fact that these like if you want to have an exchange on U.S. soil, you have to follow the rules that are put forth, all of the regulation, all of the ruling, all of the constraints, all of the reporting requirements, and it's horribly expensive to do that. And I think that looking at what happened with FTX, there's a really, I mean, it made sense, I guess, why they set up outside the U.S. because you can't do the things that they were doing. I mean, legally, the things that they were doing legally, you can't do those inside. I mean, on U.S. territory. That's why they were domiciled in a place where you didn't have to follow certain regulations. It made it easier to conduct business, albeit it made it more risky. But circling back around to why are we talking about the Fed and Powell, and why do we care is because it's the fundamental, like the people that are like most integrated into the fundamental layers of the financial system, not just here in the US, but globally. And the fact that the financial system is now global in nature and interconnected, and you have entities from all over the globe all participating in crypto markets now, they themselves are influenced heavily by policy. So we're talking monetary policy from the Fed, but also fiscal policy from the U.S. from Congress, from the U.S. legislative apparatus. They have a lot to do with how the big financial entities work, whether they're banks or uh, like the Morgan Stanleys and the Fidelities of the world operate, because they have a fiduciary responsibility. And people go to jail if they don't follow the rules. I mean, in the U.S., they go to jail sometimes, not always. But anyway, I think that's a good way to summarize why we're talking about interest rates or talking heads. So I'll back out to the bigger picture. So tomorrow is kind of a big day, I think is fair to say. And looking in,
Our speech tomorrow, Ted, this wasn't something that was planned, was it? This is kind of something they added on. Is something that this isn't. I thought I saw an article, and I could have been wrong. Uh, that this is something that this wasn't on the agenda previously. This is something they added on. Is that right?
it may be right. I don't want to say that it's wrong right this moment, because the way I understand is that these, like, there's like the most obvious event, or yeah, what's the word I'm looking for? The most obvious, like, heavy hitting events are the FOMC meetings, and then the announcements. Those are the big ones, and then in between they pepper these. I I have to believe, and maybe I'm wrong, but I don't. I mean, until somebody tells me that I'm wrong, I'm going to operate under this assumption for now. Is that they have a ton of these Fed, or all of the Fed folks have a diary or a schedule of speeches that they're going to give throughout the whole year, and I believe that they plan these things, somewhat in advance, and it has to do with, like, pre-Fed or pre-FOMC, post-FOMC, and then just a schedule of events where they're basically making appearances like they're celebrities going on tour or something to that effect.
Sure.
That's what I that's what I think. I could be wrong, but I believe that this has probably been on the calendar for a while, in a manner of speaking, quote unquote.
Got
And
it.
the other Fed governors, they have their own, localized speaking agendas. The big boss that I used to work with at the fund was really good, is still really good friends with the former Dallas Fed chair. And now that I want to talk about him, his name escapes me, but dude has glasses. Gosh, I could see his face in my head, and we used to always get a chuckle when he would be on CNBC. I never got to meet the guy, but I'm hoping I can, like, cash in one of these chips one day. Big boss is in Dallas now, and that's where Richard something, I can't remember. It'll probably come to me in like 20 minutes when we're talking about something else. Okay, naturally.
Yeah.
And then as
So,
far as,
so
like, oh, sorry,
why
go
we're
ahead.
on this, like, let's talk about real quick too, because I think one of the biggest things in crypto for people to understand, or people just getting into it, it's very important to understand how our money works first, right? And so when we say Fed, we're talking about the Federal Reserve, which is the central bank of
Yes.
the United States. Is that correct? Did I say that correctly?
Yeah, we are talking about the Federal Reserve Bank of the United States, and I thought your point was well articulated. Is that we are talking, we have to, before we understand how to use magical internet money, I think it's really important. It's something that I was asked to do earlier in my career, almost 9 years ago, was to understand how the financial system works in the United States, like where the US dollar came from, looking at uh, Bretton Woods, and how, like, which was, if you read the Peter Zeihan et al. Accidental Superpower, Absent Superpower Fame, talks about how Bretton Woods was basically the kickstart of globalization and the beginnings of the U.S. dollar becoming the world's reserve currency, et cetera, et cetera. But also reading another book called Understanding Modern Money by L. Randall Ray. That's Wray. That's a really dry and tough book to get through, but he goes back over, relatively speaking, concisely, over 4,000 years of money in the world, and what a bearer asset is, and how we were on the gold standard and then we were not, et cetera. It's way too much to unpack. We would have to do like a 20-hour live stream to even
Right.
get
No,
through
it's
like
it's
half of that. But
complex. It's complex, and it's complex for a reason, right? And so another one I throw on there is the creature from Jekyll Island. What we should do is kind of put like a educational thing together, a list, so people can go and kind of do
oh,
their
I
own
agree.
research on that. But part of what we're trying to do here is educate people. And the biggest thing, if you never touch crypto, personally, I don't care. I think if you learn about money, then we've done our job as educators, right? Because I think that's one of the biggest problems we have right now in the United States, especially, is nobody knows how the money works. You might make a lot of money, and this was me before I got into crypto. I did really well as a real estate broker, commercial real estate broker, made good money, had no idea how our money worked, zero, none, and we're not taught that for a reason. So If people do anything from this, learning how our money works, learning what the Federal Reserve is, why does the entire economy depend on what some old dude sitting in an office does with interest rates, right? Why is the world like this? And if you can understand that, understanding crypto will become a lot simpler.
Oh, I agree with that 100%. And I'll share also from the time I got into tech in 1997, my background's in technology, working with systems and networks primarily at the beginning, and then getting into applications and then software and building software and understanding how to put those things out into the market and ideally try to like earn a living doing that. It wasn't, and maybe I should be embarrassed to say this, but I don't really feel embarrassed about it because I didn't have, there was no one around me, or I wasn't in a circle where someone was like, hey, you need to take a look at this until about 2015 when someone ripped my eyelids off in a good way and said, look, the US dollar is the way it is today because it is no longer on the, or pegged to the, or the gold, we're not on the gold standard after Nixon took us off in 1971. So you need to go back and understand, like in the old days, when you had, or what a bearer asset was. And in the old days in the US, it was gold. And you wouldn't carry your gold around because you would get robbed and killed and it was dangerous. You would take your gold to the bank and deposit it, and in return, they would give you a paper equivalent that represented your physical money, your physical commodity money. In this case, it was in the form of gold. And then you would take your paper notes, these like they're called a bearer note, and then you would go and transact. And this idea of currency, meaning it was fluid, and you could go and settle your debts with other people using this derivative of this paper that derived its value from another entity. And then at the end of the day, you could take your notes back to the bank or the depository in this case, and you could redeem them for your physical gold. So you were able to transact with your money without actually having your real money. And this was something that I didn't even fully understand as an adult until probably 2015. And so it's not even been it's not even been that long for me personally. But I'm really thankful that I was, in a manner of speaking, forced before I was allowed to do other things at the fund in terms of like digging in and making recommendations for positions that we should take long or positions we should take short. I had to understand literally how the financial system worked and why, when the Fed chair speaks, everyone around the world listens because it helps shape the directions of these it helps shape directions of price movement of things globally, and that's why we care, because it's leached its way into the crypto scene in a manner of speaking and affects literally everything to some
Yeah,
extent. So
there's another book too while we're on the topic. It's called The Central Bank, the Only Game in Town. And the author's name's escaping me right now. But again, the most important thing here is to understand how the money works and why it works the way it does. As you alluded to, we went off the gold standard in 1971. I think people
mm-hmm,
have to understand, for the majority of our lives, we've been running a financial experiment, right? With the United States dollar. Okay. And so what that's allowed, you know, to happen is you've had all of this debt be created into the system. And when it first started, right, this is something that's interesting, and maybe you can help me kind of elaborate this point. When this money system first started, it was very good for the participants at the front end of this cycle, the fiat cycle. Now that we're getting to the back end of this fiat cycle, the 50, 60, 70 years have gone by. Typical lifespan of a fiat currency, government printed currency is, 60, 70, 80 years. We're about there. The participants at the back end get hosed because the money becomes worthless, right? And so it's not backed by anything; it's backed by debt, right? Essentially, so all of the people, if you were born in the 1950, right, and you got to come through your 20s, 30s, and 40s in the 70s, 80s, and 90s, the systems worked really, really well for you. Okay, if you're a millennial born in the 80s, 90s, or 2000s, the system hasn't worked as well for you. Yes, there's still opportunity. Yes, you can still become wildly wealthy. There's all kinds of things out there, but the system, it's not as easy to become wealthy because the money's broken, right? And that's what we're really
mm-hmm.
trying to articulate here with crypto, the Fed, understanding how the money works. because people, the biggest thing for me, and this is something I'm passionate about, is we only have so much time on this planet, right? And so people spend their entire lives chasing dollars that are ultimately worthless, right? And so what you should do is trade your labor in for something that has value. And in our opinion, it's Bitcoin, right? And that's something that really opened my eyes. We can get into the weeds with all this stuff, but going back to why this stuff matters is because when you wake up every morning, you go to work, you do this for 40 years, and if you never understand why, you're just part of the system. You'll never be able to, protect your wealth. You'll never be able to grow your wealth, right? You got to understand how this game works, and that's something that we're going to try to help you out with. And there's people on every level, right? There might be people that watch this and say, "Yeah, everybody knows this," but I don't think a lot
Yeah.
of people. I don't think a lot of people do know this, right? And there's a reason they don't know it, right? And not to get into politics or conspiracy, but it's benefited the current system to have as many people clueless about this as possible, right? It's not that the information's hidden; it's out there. It's not rocket science. It's not hard to figure out. It's like you said, you had your eyelids ripped open. You escaped the matrix, right? And that's what it is. And so, sorry, I just went on a tangent, but I think it's important to understand, the high level picture of all this and why this stuff matters.
I could not agree more. And I think on this on this journey, there will be a lot of opportunity for us to communicate like this idea of fiat money as it exists today, uh, by design continues to hold less and less and less of its value, and you need more and more and more of it to buy the things that you could buy previously with less of it. And that is as a result of an entity like the Federal Reserve that not only dictates monetary policy in the form of the interest rate decision, like this idea of like deciding what the interest rate is going to be today versus next quarter, or 3 years from now, whatever. But the fact that the money supply, the quantity of money or currency, I should say, that we use to transact doesn't we can't take that currency instrument and then redeem it for the base layer or the bearer asset. That's not, we don't do that. And I'm still trying to get my head around, like, you're trying to understand how to navigate the current environment in such a way that 10 years from now, the labor that I'm trading, the time and the energy, the effort that I'm trading in return for US dollars right now, how do I'm being selfish for a second, but I want other people to benefit from this idea that, yes, I'm getting compensated in US dollars today. Now, what do I do with those dollars so that 10 years from now, the same number of dollars that can purchase X amount of things today, will it still be able to purchase that much things later? Probably not. And if you look at, 100 years of, aggregate US dollar value, you'll see that 100 years ago, you could buy a lot more for a single dollar than you can today. And we'll dig way deeper into that. I think we should devote, like, just a side note here, mental note. We should devote like certain day. Maybe there's a day of the week that we devote to looking at like Bretton Woods forward, and just do like a 10-week series on
I
how we
agree.
got to now, kind of thing. I think that
Agree.
would be, I would personally be interested in that. It would probably bore a statistically significant number of people that weren't going to be interested in anyway, and help us like gather
Well,
the right kind of audience. But
here's the
get
here's the issue. Here's the issue. They may very well be bored, but we're running off a cliff, and they might be bored with it, but they're going to learn one way or the other, right? And so the goal is
yeah.
to kind of get as many people out of the van that's hurtling off the cliff as fast as you can, right? Like, and so, I think even if you reach two people, right, like that's worthwhile, and then it'll help us too with our understanding, because it's always good to go back and kind of, there's maybe stuff that I missed when I was learning all this. This has been a journey of 5 or 6 years for me, and you don't always go back. You learn something once, and then oftentimes you go back and you learn something else too, right? And so I don't think there's any harm in doing that. And I would also really enjoy that. So I think that's a great idea.
Okay, super. Mental note taken for the recording. So super duper.
All
I'll
right. Well,
whiz us through
let's
the
see.
last part of the calendar for the week. In terms of like other things that will probably have some influence more on the stock market, like U.S. equities than anything else. Again, we see more like on Wednesday. We've got Barr and Williams. The housing information or the housing numbers, I think will. I'm sure the media, the mainstream media, the mainstream financial media will have something to say about the numbers relative to this, this insane run up in housing prices post March 2020 to then having it come back or having come off the highs in a manner of speaking in terms of like the number of new home construction numbers, the Case Shiller number, mortgage applications, all of these things that are typically lagging indicators uh, that can be used by the financial media to try and you know drive ratings primarily. Again, I'll get off the soapbox in a second, but the thing to keep in mind is that these types of releases are, I mean, they do move the needle. And in previous years, we saw that Bitcoin, especially, was pretty much pegged with S&P 500 and the Nasdaq. Like when the Nasdaq would trade up, Bitcoin would trade up, and the consensus largely was that you traded Bitcoin like it was a tech stock at the end of the day. And when certain other economic indicators were being portrayed as being negative, and the Nasdaq would then would move lower to price in something unsavory, then Bitcoin would and other cryptos would follow that, because that's just how people were trading. The mental model and the framework for the largest number of participants in the market was to trade it like something they knew or something they understood already and had exposure to, because it's relatively new. So another thing on the calendar here, like we got the EIA, which is the crude oil stocks. I think I don't know. I take this crude oil stuff with a grain of salt, especially with the shale revolution in the United States. This is a whole nother can of worms, by the way. This whole like energy independence thing, the shale revolution. Peter Zeihan has great stuff in his books on like how we're able to, you know, posture now against OPEC as a nation. And but the tech, so the big disconnect on the oil thing, and I'll get off this soapbox brief in a moment, is that the number of oil rigs, which used to be a really important indicator of like how well the oil business was doing, and which implied how much demand there was. I mean, was the economy healthy enough to drive demand for gasoline and petroleum products? The number of oil rigs now, it's harder because of the tech. The tech and the shale business is now able to make the existing number of platforms, orders of magnitude more efficient. And just because there's not more platforms doesn't mean there's not more demand that's showing up in the form of orders to buy or consume the raw materials that make all of the things that we buy, including plastics, anything that's from distillates and like CD, well, not CD players anymore, but things like the plastic stuff on my phone that comes from petroleum or that's based as petroleum based. So the oil numbers, you got to take this with a grain of salt, in my opinion, unless you're really deep into trading oil. Um,
Well,
Going a little bit further,
it's all important
sorry,
though,
go ahead.
because again, as we zoom out, why this matters, because there's so much going on in the world, and crypto is a very, very small part of that right now, right? It's becoming a larger
That's right.
part. And I really believe this is where normal guys like you and me and anybody watching, this is our opportunity, because as you alluded to earlier, Wall Street trades this like it's something else. I don't think these guys are really, really smart money guys. I don't know if they fully understand what Bitcoin is yet, because if they did, they wouldn't trade it at all, right? They would try to own it as much as they could. And we talk all the time. We're in a flat panic to get more Bitcoin. And I don't see how the rest of the world doesn't feel the same way. But the point was that all this stuff, oil, like the euro dollars, what's happening. There's a big game happening right now. And we're not told any of it, right? You get little glimpses. And so like the Fed speak,
Hmm.
that's a little glimpse. That's normal guys like you and me, guys and girls can use some of this information to help us a little bit, but we don't have the whole picture, right? What we're trying to do is just paint as much of the picture as we can and kind of use that to, I guess, frame our outlook on the world and these markets and where they're potentially going. So all of this is extremely
Yes.
important to understand. You don't need to understand it in granular detail, but you want to have it on your radar just because it does affect. And as crypto continues to grow, it's going to become a bigger and bigger part of this. And what's interesting about the crypto markets is it's a whole new asset class being born right in front of our eyes. And that's something that, you know, I've never witnessed in my lifetime. And I think it's hard for people to get their heads around that, right? Especially traditional money. And again, going back to the earlier point that I made, if you are in the system early, it works. What the hell do you care about Bitcoin? Bitcoin's crazy. Why do we need to change anything? The dollars work. It's made me tens of millions of dollars. The system's great. Why do I care, right? Like, but for guys and girls that weren't in the system early, it hasn't been that, right? And so I'm being very general here, and I hope the point's coming
Hmm.
across. But this is where we think the opportunity is, and to fully, I guess, understand the opportunity, you have to understand all these macro kind of deals. Now, you don't need to understand them in detail, but you need to have them on your radar. Does that make sense?
Yeah, it makes perfect sense. And I'll summarize it, or just or emphasize that last point is that if you're paying attention to the macro drivers in some way can save you, or keep you out of trouble, and at least at a, in some cases, and I'll articulate the point like this: there are times when I would be trading spot currency like dollar yen or euro dollar or euro yen, something to that effect, or Aussie dollar, and I would get stopped on these massive moves, and then I would go back and look and try to figure out, like, how the heck did I miss out on understanding why it moved like this? And it would be the like Royal Bank of Australia, RBA, would raise rates, and I wasn't paying attention. I wasn't looking for what other central bank was going to either raise or cut rates, and how their monetary policy was going to directly affect the trade that I was taking. I was just looking at charts early days and learning technical analysis and trying to ideally make informed guesses around which way the chart or which way the price might move. But when you know ahead of time, for example, if the Royal Bank of Australia's economy is either doing great or it's in the tank, and you know that from a legislative perspective, the the monetary governing body is going to enact some sort of rate policy to try and change things and boost their economy, then you can profit from that by taking a position in your local currency versus their currency, like Aussie USD or Aussie yen, for example, and play that. There's a money making opportunity there. But if you don't understand at a minimum, if you don't understand the macro drivers and like what could happen and whatnot, then it makes it difficult, or at least you'll be confused at a minimum.
No, that makes perfect sense. And then too, what's important to remember too is looking, and I guess we can go into this. Maybe we have something on the lines of, because I think it's important to reiterate. There's many different time frames that we're looking at, right? So as
Hmm.
investors in crypto in general, our time frame is years, okay? And then so as we move to trading, some of these assets, our time frame is days and weeks, correct? So I think it's important, like in the same way you keep an eye on macro, you also have to keep an eye on, the secular trend of cryptocurrency over the next 5 to 10 years versus the day to day. And I think I don't know how to organize that right now correctly in my head to where we can always make that, impression on people that are following and listening. I think it's important to, at least for me, when I look at investing and trading and stuff, one of the things I learned was, your time frame definitely matters. Uh,
Yes.
and so I think that's important that we articulate to people too as they get into this, because there's different ways. I mean, you enter a trade on Ethereum for 3 hours to 3 weeks is a lot different than a position in Ethereum over 5 years, right? And so all these things play into it. But sorry to get off topic there. I kind of jumped around on us.
No,
I
no,
just want to mentally note that.
that's well put. Timeframes matter. Your investment thesis matters. The your capital, like how capitalized you are as a participant in the market matters, and whether or not you're in this to make short-term profit or if you're trying to build a position that hedges against the devaluation of your local currency over time because it's a fiat type like the US dollar or the Great British Pound or the yen. Anyway, those things matter, and we can definitely inject this idea of thinking in terms of longer time frames versus short-term time frames and how the two work together to form a like more holistic idea of like building and protecting wealth, but doing so in a way participating in the financial markets as a market participant, like trader participant, by buying one asset that appears to be undervalued in the hopes that it will go, and then if it doesn't, if the trade goes against you, how to protect yourself from getting wiped out in one shot is a good place to start.
Well, yeah, that's
The
well said, well said. And this is great because we've got so much to cover, right? And for us, our job is going to be getting this into a concise, organized manner that helps the people that follow this journey with us really understand, what we're trying to articulate, and really can help them. And like we've talked about, we're here to learn too. So
mhm.
this will be a learning experience for us. And I think that's where people can really benefit from this too. Is first educating yourself about how the money works, and then understanding the different ways to kind of take advantage of what's going on right now, because it is an opportunity. I mean, this is the opportunity of our lifetime, in my opinion. And you don't have to get it exactly right. You just have to get it a little bit right, and you'll be all right.
Yeah,
So
I'll put a bow on that. The opportunity is unlike anything that I've ever seen, and folks that are 20 years my senior agree largely, even though they some of them participate, some of them don't. But the point I was trying to make is that these things happen to they're generational in nature. I'll leave us with this point, and then we'll spend the last 20 minutes looking at charts and whatnot. We'll touch on a couple of news items, but the point I was trying to articulate is that in the same way that when the guy I used to work with was starting his trading journey, it was commodities and like gold and silver especially. There, like he started in the 70s, and I was a child to put it in perspective. So, and then they had their inflationary moment, and it provided opportunity to position. And really, at the end of the day, I think what we're all trying to, or what I'm trying to understand, and I think you're probably trying to understand as well, is how to position appropriately for the conditions. We can't influence the conditions; they are what they are. But this crypto markets represent a generational opportunity to create wealth for yourself and protect that wealth moving forward from things that we have no control over, like sovereign nations attacking each other, uh, mon- uh, monetary policy or monetary bodies like or entities like the Federal Reserve in the United States and other central banks, so the central banking entities that change interest rates without considering, or maybe they do consider, but doesn't they don't factor in at the individual level like how it's going to affect individuals. I mean, we have an opportunity, even though it seems unfair, perhaps is one way to think of it, but even though it may seem unfair, we have the opportunity to participate in such a way that protects us from all things political, like geopolitical, local political, national political, and other like big, massive things we have no control over. Like, and I'll put a bow on this section here, is like we have our unemployment data coming out on Thursday. A lot of people are watching to see if the recession is here. I mean, I guess it literally depends on like who you are and what kind of work you do right now. If you're affected or not. I know that the spectrum is wide. And I'm going to be paying attention to the unemployment data, which may influence what the Fed does in the future. And I, at a minimum, think that it will influence what Wall Street does and the things that they will price in aggregate.
Yep. No, I think
And
what
then
variables.
rounding out the week, it looks like we just have this is a big one. I've in my experience, I mean, it's big at the time, but the consumer sentiment, the Michigan consumer sentiment, and then the inflation expectation information, these releases, they they basically tell you, in my opinion, just like either like how like euphoric and out of touch with reality people are, or how terrified and also out of touch with reality that the people that participate in the studies are. It's, I mean, again, there's a spectrum, and wherever you fall in the spectrum, I mean, if you're a trust fund kid, then you don't care about the consumer sentiment numbers because you're not really like having to work and compete in the labor force for a relatively small amount of financial the resources that are available to compensate the labor force. But if you're in the labor force and you're working at a restaurant and you're making your $2.15 an hour base and you collect tips, and the consumer sentiment is low and people aren't going out to eat, and there's a ton of waiters and waitresses all competing for the same restaurant half full of dining participants, and you're not getting tips like you used to, you're sent look, you may not like that, and you may feel the pinch financially. And if you don't have a lot of savings, I was a look. I'm a perfect example of this, of what I'm saying here. When I was how old was I? I was what, 18? No, I was 22 years old. Didn't know what I wanted to do with myself. I'd been a musician and wasn't very good at it. I didn't make very much money. Uh, I think in 2001, I made like $11,000 that year in total, the whole year. Wow. I was unemployed on 9/11. I had been a waiter, and there just wasn't enough dining demand in the area that I lived. And I was one of these people that if somebody had asked me on 9/12, I would have been like, everything sucks tremendously. Not only did we just have a massive terrorist attack, I not only got laid off from my tech job, but I also didn't have any work available to me as a waiter in a relatively affluent area of like the Washington D.C., the tech bubble or the government contracting bubble, as it were. The funding for the contract that I was on dried up. Couldn't make any money as a waiter. I was ready to move back in with my mom, and it was I would have said everything is in the toilet right now. And so you look at this stuff and take it with a grain of salt. It just if you ask someone in New York who's living in a $10 million house and has $100 million in the bank, and they have 43 sources of income that they don't have to work for in an 8 hour day, 250 days a year for, then they're going to feel differently. That's just my 2 cents on that.
No, no, no. That was well said and something to consider. I mean, I'd never thought about it in that context, but it does matter, and it matters too in the crypto world too, because you've got people that right, a lot of the dollars that come into the market right now are retail dollars, and that's going to change as institutions come. And we
Agree.
can talk about one of the other advantages that we have right now is regulatory arbitrage, right? Because the big institutions can't do anything until they get regulatory clarity, but you and me and every other Joe Smo out there can, right? Because we're not subject to the same rules. So
Right.
I like to think about that as kind of our opportunity. There probably is some games being played at a very high level, because if I'm those big institutions, I don't want to buy Bitcoin at 100 grand. So I would be shocked if they're not in at some capacity already. I don't know that. I don't know how to know that. But I would think that happens over the next 2 to 5 years in a big way, just based off, again, going back to the macroeconomic environment, what's happening all over the world. And another thing we can get into is the game theory of Bitcoin and with these central banks. At some point, they're going to recognize that their only option, I guess, I forget the quote, but the only option here is to play. The only way to win is to play. And that
That's
quote
right.
might be, the quote might be the only way to play or the only way to win is to not play. But this game is the only way you win is you have to play, right? Because you don't want to be, I guess, I forget who articulated this. You don't want to be the first central bank, but you don't want to be the last either, right? And so we're
I agree.
starting to see some of these countries, some of these South American companies or countries that are smaller in nature, take this on. And so I think, I think maybe what you see here pretty soon is one of these larger countries that nobody's expecting to kind of maybe not come in and do what El Salvador did, but be very, very open to, Bitcoin is legal tender. And you might see some, I think in the near future will announce that they have it on their balance sheet.
Also, well said. I agree with that. The last thing I want to leave us with, and then we'll do some chart, and we'll just look at some charts, make some fundamental guesses about what we think might happen. There are
Yep.
two really good sites other than trading. So tradingeconomics.com, I use this for years to do my gopher work. Go for this, go for that, Ted, at the fund. And it served me really well. Another interesting website is called Crypto Panic. I was going to tell you this last night when we were preparing for this, is that when I look at Crypto Panic, it's like the poor man's Bloomberg. It's a dark screen and the yellow. And if you click on some of these items, what's really great about this is that it's a news aggregator. It's really well done, and you can look at various like categorizations of this content, and one of the categories is LOL, which I think is hilarious. But you can also search. So if you're interested in sushi swap, or if you're interested in Aptos or Phantom or Render or Bitcoin or Ethereum, whatever, it doesn't matter. You can search, and then they have a paid plan that I'm sure is excellent. I may spring for this, but it's great to not have to go out and try and dig up all this stuff. These guys do a really great job of that. I don't know where they're based. The reason I say that is that the next one, so cryptopanic.com is one.
Okay.
Cryptocraft.com. It happens to be a fine gentleman by the name of Richard Schmid, I believe. He's in Tampa, St. Pete area. But I met him at one of the Tampa Bay Bitcoin meetups last year, last the last 3 years just are like time doesn't matter. Time doesn't mean anything to me right
Right.
now. it,
It's been
Anyway,
strange.
CryptoCraft is another good one. I wanted to show here where I was going to go is that the big scary economic calendar that we were looking at before that had like all of the majors around the world. This one is fine tuned for the crypto world, and you can see it's much easier to digest. So, in summary, is that today Biden's going to speak. Tomorrow we have the Powell and the trade numbers. Wednesday we've got the unemployment, and then, or excuse me, Thursday is unemployment. Pardon me, and then we have the UMISH consumer stuff. So this is a much more concise view of the quote unquote economic calendar for the week ahead, and they've done a really good job of this. And so cryptocraft.com, you should follow them on Twitter. Crypto Panic, probably should follow them on Twitter too. But I think this is great stuff.
Awesome
I
stuff.
haven't even scratched the surface on Crypto Panic, for example, but I think they're both great resources. Um,
The other one I
and
would
with
throw,
that,
the other one I
so
throw
go
in
ahead.
Mesorai. They've got a
Oh
good.
yeah,
They're a great research company. The other, you can look at too for pricing of assets and stuff. There's CoinGecko, CoinMarketCap. But like with Mesorai, I think there's a paid service for like $29 that will help you with research. And that's something too we can get into is how in the world with all these crypto assets, when you look at how do you know what's real and what isn't, right? Like, and
right.
that's a bit of an art, right? But it's not something that's like super complex. That just comes with time, and a lot of that research can be outsourced, right? For lack of a better word, like Josh Fahovic isn't going to be able to tell you, what company XYZ in crypto does. There's 30,000 of them, right? But if you can look at 4 or 5 different pieces of research and aggregate, you can narrow down which projects are real, right? And that's really all you're trying to do, because in a long-term bet you're making, again, you don't have to be 100% right. You just have to be in the game, because it's a secular trend over 10 years. And long way of saying Mesorai is a great research tool for that. Stansberry research, but we can go into all these things too, and maybe we do a video exclusively for resources. Uh,
Agree.
that way people
That
can
would
kind
be excellent as well.
of, yeah, go through it at their own pace.
Super. All right, I'm going to transition now over to one more time just to be diligent here. We're going to look at some charts. You may see some risk reward drawings like long position, short positions. These are only suggestions. These are just ideas. I'm not currently in any trades, and I'm not going to be recommending anything particularly. I'm just going to talk about what I'm seeing. And with that, I'll get over here to our charts. So what we're looking at and you can see this all right, Josh, or do I need to fire that up for you real quick? I think I
I'm
need to
still,
change that
let's
up.
see, what I'm seeing right now is the Mesorai
Got it.
chart.
I'm your Huckleberry. Hang tight. I'll get that for you. We are looking at the sushi. All right, I'm gonna jump back over to our Ethereum chart that we've been chopping to pieces for days and days and days now. But interesting thing, and just to bring everyone up to speed, we've been watching Ethereum coil inside this wedge, just a 4-hour time frame, looking at this behaving very, very interesting behavior here. How this is starting to fill out this area. We had the biggest news event recently was the expected 25 basis points, which I think the market was happy about. And I'm talking globally. Markets were thrilled that we only raised 25 basis points instead of 50. So things of note during, and harkening back to why do we talk about this, is that it definitely moved the needle here. You were either caught short and got squeezed out, or you were waiting to initiate a long, or you were already long from back here, and maybe you were adding on this move, breaking out. But you see, confluence is another thing that we want to try and understand when doing chart analysis. Is that we see right after that we had some earnings reports, and it definitely pulled back a hair. I mean, we're not talking massive move here, but it definitely is consolidating now around this area. And one idea that we've put on the table to just to review was to potentially, as we came back and retested this like halfway point between this top or this high and this low here, which was tested twice here, as it's resettling back towards the middle, is if the macro picture is still good, meaning it's not the apocalypse, um, then what else could it be? Our FTX black swan is behind us now, for the most part. There's collateral damage and people got chopped up pretty good there, but they're not the market in general. And what else is on the horizon? We've already, we priced in this Russia Ukraine thing a while back. Um, so what I'm saying is that potentially a short term idea would be to get long in this area on a sustained, uh, or I guess on sustained staying in this zone, meaning we're at the top of the support range. Meaning if people are piling in short here and we get a little move up, it may squeeze them out. They may get stopped out and use that momentum to ride out. And I'll go to the daily and put that in a little bit of greater perspective. So to summarize why we think this might be a decent long is that assuming that price hovers around this area, we get long, tight stop, 4-to-1 risk, we see another pretty big resistance area back here from September, very well defined. I mean, there's no question like that this. People said, no more, and we came back down. If this, that to me indicates that if we were going to take a short-term trade long, we would want to exit sometime before we got up into this congestion area. And if it got into this area and we took profit or we took half off, then we would look to either get out if it started to pull back. If it broke through this, we could add, and the next resistance zone is back up in this area. I'll pause there for a second. Anything about what I just articulated, Josh, from your perspective that looks weird or wrong, or
Yeah,
what do you see when you look at the chart?
So what I see here is when you mentioned something out on the horizon, the only thing on the horizon for Ethereum, barring some other macro headwind that we don't know about, is the Shanghai updates, and that
Ah,
will allow people to unstake their Ethereum. Personal opinion on that, I think it's bullish. I think what you'll see is people who were hesitant to stake their Ethereum before now look at this as a de-risking event and will actually stake more Ethereum, something I'll probably personally do after the Shanghai update goes through successfully. But that's something that could affect our idea here. Now, is that happening? I think it happens in March. So we've got 2 or 3 weeks. Does that implement? Does that affect the trade we're making today? Perhaps, maybe a little bit. The other thing too is I think it's when we go through these charts too, is to kind of explain to people, and I'll do a good job of this because I am dumb when it comes to these charts. So I'll ask you these questions. I'm the
hey man, me
perfect,
too.
yeah, the perfect guy to ask. So like, we're using a Fibonacci retracement. That's what you see, all the different colors and the lines. Because I know when you first start looking at these charts, it's like, what in the world are these guys doing? This is insane. How does
Hmm.
anybody make any money drawing lines on charts, right? And so you got to look at this as kind of it's a tool in your toolkit, right? Like it's not gonna, this alone will not, there's a lot of people that I say, and maybe you can give me feedback on this. Like a
Sure.
lot of people say the charts are all that matters, and that's I think that's partly true. I look at these markets as a whole going higher over time, and the charts are something you use to kind of individually pick off some potential opportunities. What are your thoughts on that in general?
I think the tools and the toolkit was a great way to articulate that. This really the framework that I have learned to use is to try and use different tools like the Fibonacci retracement, like the RSI, like the indicators and the other tooling inside of the charting system, whatever that is. I mean, any charting system would be fine. Uh, Quick note: the big boss used to chart by hand,
Really?
and that yeah, and it says that he wishes that he could do that. Well, in 2017, when I was still there, said that he sometimes wished he could do that because it forced him to. All right, when you write things down and use a different part of your brain, it helped him like really understand what he was looking at because he had to make it, and it helped him understand ranges. Like we're basically caught in a range here. I mean, there's a little bit of a move up here. What I would be looking for, and the reason that this the confluence that I'm looking for is if the RSI comes back down, we come back down to this 50% and then pop back up through this level and then retest this little wedge line here. That would to me signal that we might be able to get a move higher. So using the Fibo tool here tells us like mathematically where like what we think is happening. Like we're just consolidating or there's distribution going on. People are swapping Ethereum for dollars and other currencies to take a position. They are positioning in this sequence here. Is the way I look at it. Maybe I'm wrong, but to me, listening to people that are a lot smarter than I am talk about consolidation, distribution, uh, I would look for confluence and then some sort of confirmation. Uh, though if it's not surprising to me that we have this full deck of economic calendar items, talking heads from the central banks, consumer sentiment numbers, and earnings reports, and all these other things that are going to influence the bigger picture. And the confluence that I'm looking for depends on what we're looking at. We'll look at another chart in a minute and talk a little bit more about confluence. But using the tools, the time frames, the news, and past experience to look for confluence that signals or that gives you a signal that says the most probable thing to happen next is that price will move higher because that's the path of least resistance, or earnings are going to be bad, or earnings are bad, and Wall Street's going to start pricing in a pullback, and we're going to see the S&P 500 is going to start rolling over, or it is rolling over, and the path of least resistance for now is lower. So, and which one of those is more probable given where you are at this particular time, and then use that to make a decision. And then last but not least, in every way, shape, or form, practicing good risk management should you independently make a decision to take a trade, always risking only the amount of money that you're willing to lose and only a percentage of your account equity, and being really diligent about using stop loss orders to protect your account from getting
Well,
wiped out
yeah,
by a single
I
trade.
think that was extremely well said, and that kind of pulled it together for me too. And the reason people do use these charts is because there is information to be gained, and it can help you kind of articulate a theory or form a theory about what's going on in the market. And so, like a Fibonacci sequence, for instance, when market structures are appropriate and behaving right and acting like it should, that doesn't mean acting like it should doesn't mean it should be going up or going down. It's just that there's no weird stuff going on in the market that's outside of normal things. Like there's no FTX event, is what I'm saying. It's
Right.
uncanny how, especially the crypto markets, respect these Fibonacci levels. And something you talk about too is a 50% retracement after a move high that we've noted on multiple charts. It's a pattern that you start to notice, right? And so over time, as you notice these patterns, and it's interesting, we had this conversation yesterday. You said you get to the point where you're in a flow state. I listened to a great podcast at 2 in the morning last night because I couldn't sleep. They were talking about the same thing. That you get into almost a flow state with these charts. And the reason you do these charts, repetition after repetition after repetition, you start to kind of, I love the analogy of seeing the matrix, right? Like, I think it's such a good analogy for charting. It's like all of a sudden, like, and the guy's point was like, look, he goes, you don't need to learn all the candle names and, know what every candle's called and all that stuff. All you need to do is repetition and let your brain do that work. And your brain will see, okay, look, there's a candle that looks like the last candle. The last 10 times that happened with the candle preceding it, the market moved up 10%, right? And your brain will start to understand these patterns naturally as you look at these charts and make it part of your daily routine. I just find that fascinating. And I know that it's true
Yes.
because it's just human. That's how our brains work, right? Like, and so that, again, we'll probably talk a lot about psychology. And again, with your point, your last point there, risk management, that's something that we're going to harp on religiously, especially when it comes to trading. Now, when you're doing
Yes.
venture investing, that's a little different, and we'll talk about the differences too. We'll do a venture days. We'll kind of structure this in a way where, most days we'll be doing news chart, but what we'll try to do is break this up to where we're going to educate you guys about venture investing in crypto, how the money works, different aspects. We want to talk about the Bitcoin Lightning Network, but I'm getting off topic here. I think Ted's point was that, look, the way you win in trading is to lose less than everybody else, right? Isn't that what you've told me as we've kind of
Yeah.
started this journey? Is to, if you could articulate that idea, I think that'd be beneficial.
Yeah. I when I started day trading by myself after reading Steve Nissen's Candlestick Charts book, and then taking a couple of online courses from some quasi successful traders. I mean, maybe they were successful. They probably made more money selling their training courses than anything else. But they I mean, some of the proof was, I mean, they had good proof in the pudding most of the time. Anyway, the thing that was instilled in me early on is that your job when you start, if you're going to start trading for real, then you got to look at like the idea that you're going to be wrong more than 50% of the time. So you need to lose less than you win, and get really good at getting stopped out of trades for very small losses, so that your account takes these little nicks, so that when the trades that do perform, they tend to perform like 2 to 3 times better than your losers do, because you let them run a little bit. You'll end up being a profitable trader. So the idea is that in the beginning, you're not really trying to win as a trader. You're trying to, at a minimum, lose less than everyone else who gets wiped out, and then really focus more on just being break even. Can I put money into the market? I mean, on, can I? Well, I'll say it a different way. Can I derive a thesis, express that thesis as a trade, where I'm putting real money at risk in the financial system, in the market, whatever that market is, And then can I get at least that much money back, or can I get only, or can I get that money back minus a 2% loss of my trading capital? And can I do that several times? Meaning you're putting money into a system that you have no control over, but you have rules that say if it does A, B, or C, do this, everything else, do that. And can you get that money back? And can you do that several times? And then over time, when you learn how to do that well, the outcome that you're actually after, which is to be a profitable trader, tends to take care of itself because you've gotten so good at managing the downside risk that the upside does things that you couldn't possibly uh, prepare for or understand that were going to happen anyway.
No, that's
So anyway,
fantastic. Yeah, no, that's great. And so what we, to circle back around, we use these charts to form an idea of where we think we should enter a trade. And then when we enter the trade, we are we know what we're willing to lose before we enter the trade. We know the amount we're willing to trade before we enter the trade, and all that stuff is we can put together an easy. Ted's already put together a video showing how to do that. Those are stuff we'll teach you guys how to do over time too. But the risk is the risk is defined, the trade's defined before you enter it, and
always.
the big concept here is, you have to. I've watched guys, and I don't know how they do this, how these guys get wiped out so consistently. They must just enter these markets and think that the trade's not going to go against them. I don't understand it. That's more psychology, right? But if you have the rules and you have a system in place, then what you said is perfect. We don't control the market. We have no idea where the market's going to go on any given day. All we're trying to do is ride, the market up or down, right? And the only thing we have control over is our entries and exits. And so if you can lose 2% on a trade, but make 8% or whatever, 18% on your next trade, right? Consistently over time, you'll win. Is that kind of the general idea?
Yeah, I agree with that too. Like taking the things that I know and the things that I think about and the the process that I've been working on developing so that I like when I lose, I only lose this much. And meaning you'll never if I'm doing the things that saying that I'm doing properly, I can show my trade history, my average winner and my average loser, and the average winner will always be anywhere between 2 and 4 times the size of my average loser, and that statistically makes it so. And this is the best part. Van Tharp talks about VANTHARP. Van Tharp talks about is that if you develop a system, you literally can't lose money in aggregate, in total. Meaning if your risk is properly managed, you can be wrong 6 out of every 10 trades you make. But because of the distribution of profit of winning trades being anywhere between 2 and 4 times your unit of risk to the downside. So if I only lose $20 on my average loser, but I make on average $60 on my winners, you literally can't lose money. You can predict. It's called there's a word that he has, and expectancy. That's it. When he teaches trader, he taught the guy that I used to work for. You build a trading system that has a number called an expectancy, and the expectancy, if you architect your risk management properly, the expectancy is such that you can literally make a living and go into any trade in any market on any chart, and you set your risk to the downside appropriately. You don't have to sweat the outcome. You just have to be in the market, and that's the thing is you always got to be swinging the bat. And if you're managing the risk to the downside every single time, you literally have nothing to worry about because you won't get wiped out because of
Yeah,
expectancy.
I think that's fantastic. And again, full disclaimer, these are crypto markets, so the participants can probably figure out a way to lose money, even if you can't lose money. So, like,
Yeah.
so the other thing too is, while we're on this topic, and if you're listening to this, you'll hear us talk about this a lot. Managing risk also involves managing counterparty risk, which means whatever cryptocurrency you exchange you're using, whether it's
Oh
Bitcoin,
yes.
Kraken, any of them, you know, you want to mitigate the amount of dollars you have on those exchanges at any given time, because what we saw with FTX can happen to any of these exchanges. Unfortunately, because the market is so nascent and new, that's a risk that's real that isn't necessarily a risk in traditional markets. And so the way you mitigate that is you only keep X amount of dollars on any exchange, and with the understanding that you are willing to lose those dollars. The second they go to that exchange, you are taking a risk. It's called counterparty risk. If you're on Kraken and Kraken goes down, or KuCoin, that money is most likely gone forever. So you have to understand that too when trading these crypto assets on these exchanges. So there's ways to mitigate that. The reason we use leverage, and you'll hear us talk about this, is to mitigate counterparty risk, right? We're not trying to degen, you know, 100x leverage on these trades to get rich overnight. What we're trying to do is mitigate our risk with these exchanges, right? And still be able to trade enough to where it's meaningful and you can actually make a good income from doing it. So I just want to be really clear that that is something that everybody individually, we assume people listening to this are smart and you can do your own research, and you're not going to see us probably post trading links. We don't want to profit off you guys' learning curve. You can research these exchanges yourself. You can do all that. I believe Ted believes that, people are smart in general, right? And,
Mm-hmm.
don't want to speak for you, Ted, but, that's something to keep in mind. So one strategy there is, say you start with 10 grand, right? And you've traded your way up to, maybe once you make 5 grand, you pull that off, right? Or you take, start with 5 and you trade up to 5, and then you pull your original out, and then you're on house money, right? And so that's just one simple way to mitigate that risk. Also using leverage with tight stops, because it doesn't matter if you're defining your risk, you can put leverage on and you're still losing the same amount of money, right? And so that's
Right.
that's what's magical about it, and that's why it exists, right? And so a lot of people you'll see in crypto that 100x leverage is terrible, it's awful for the system. Well, if you're an idiot, sure, like it's not good for you. But like if you're managing your risk, and maybe idiot's a strong word, but as you're learning this, you shouldn't be necessarily using leverage. But you'll see us do it because we're defining our risk. We know what we're going to lose, and we're not worried about it. So I just wanted to say that in our first video. I'm sure you'll hear us say it a lot, but it is really important to understand that that's part of the risk you're taking when you play this game.
Excellent. And that is exactly right. So managing your capital, managing the risk that you're taking with your capital, also managing the risk that is ever present when you put your capital somewhere, really important things. And I think would be a great opportunity for us to build some content resources around discussing the details around what it means conceptually to say you have 10,000 US dollars to put to work in the markets. You may only move 2,000 of it to the exchange, put on some trades, manage your risk appropriately, and then as you start to profit, move some of that back until you have effectively earned your $2,500 worth of US dollars in winnings, profitable trades, and move that back out, and so that you have $2,500 of profitable trade capital that you've earned. You may then take your 2,500 and move it back. Now you have 5,000 on the exchange. 2,500 is your initial investment, and that's really the only really the only money that's really at risk, since the other 2,500 would be profitable trade winnings. Now you have $5,000. You can adjust the amount of risk you're taking. 2% of 5,000 is more than 2% of 2,500, for example. But really, the most important thing to remember is that as your capitalization grows and you have more capital firepower, risking the same percentage allows you to take more quantity without taking greater risk in terms of quantity of position size. So the position size can grow, but the amount of risk that you're taking stays the same. And back to that idea of system expectancy, if you really are good at managing the downside risk, the system expectancy goes up. And it's just a matter of getting into the market, being in the market, and letting it do its thing. And you have no control over any of this stuff anyway. So,
Nope,
but you got
I
to be in
agree.
it to profit. So let's take a look at one more chart. Wanted to show the sushi chart because
Oh wow,
I had tried.
you nailed that. Wow.
I tried. We talked about how I had tried to fade this or short. sell it back down to this area ish, but got stopped. Again, my risk management got me out so that I didn't suffer a potential move any higher than this. However, what we're looking at here is, again, Fed raises 25 basis points. We get this. There's this little established area of resistance that gets broken out, pulls back slightly, and then moves higher. And then now he has come back. And the idea was that, okay, the short didn't work out. That was just one idea of many. The new idea is that this former resistance level here would then become support if we had a relatively strong defining move higher. So yesterday or the day before, we drew this box here to suggest that if we wanted to take a 4-to-1 risk reward trade, we would be looking to enter on a pullback back to this new support level. And the idea is simply that if this were to break down, then our risk reward parameter here is for a 2% loss on a $1,000 account. So we would lose $20 by taking a position size of 183 units. If the price comes back to here, we'll get out because it's retesting this layer. And if this were to hold, then we could initiate another long. Or if it were to break down, we could sell the weakness that would be confluence, looking at RSI, looking at the macro, looking at sentiment, and looking at price action. If this level were to be retested, this higher low, and we had a move down, then we could sell that move. But if we had taken this trade, if we had taken this trade last night or early this morning, U.S. Eastern time, then we would be in profit right now. We would be looking for it to pull back and get some other folks long that were looking to support the market here. And the idea is that it would test this. I'm going to zoom out a little bit, a higher time frame, so you can see if we were, I'll move this over a bit. If we broke out higher, got past this previous high, which was Fed day, or as a result of the Fed FOMC, I should say, then the next major resistance level is up in this area. But 4-to-1's a pretty decent risk reward. So you're risking $20 to the downside to make 80. Let me summarize what I'm explaining here by what my former big boss would say to me is that he doesn't care if you lose money as long as you're adhering to your risk management rules, and the market doesn't care if you lose money. But if you don't take the swing, then you have no way of knowing if you would have been able to profit. And if this were to work out, it would have been a good trade. It would have been a good winning trade. If it didn't work out, let's say I got stopped for the $20 loss, it would be a good losing trade because I let my rules enforce the actions and it wasn't my emotions involved. If I were to put on a 100x levered long and it ran up and I chose to take profit, say over here, because it ran that high, that would be a bad winning trade because I didn't have a stop. That would be a bad winning trade because I wasn't playing by any rules and it was purely emotional. And then if I were to, let's say that I sold this move down and got liquidated because I didn't have a stop in my short and I went 100x levered long or levered short in this case and got liquidated out of the market, it would be a bad losing trade because I didn't have any rules and I let it wipe out my account. So there's 4 types of trades that we'll talk about moving forward: is a good winning trade, a good losing trade, a bad winning trade, and a bad losing trade. And whether or not you're using your emotion to make the decision or if you're letting your rules dictate the action that you take will serve you well. But anyway, I wanted to, as
No,
our last
that's
example here.
no, that's unbelievably powerful because I don't think people realize it. I can tell you in my crypto trading experience, I've been an emotional donkey, right? And that's why I don't. That's why I don't trade. Well, here's the issue. It's fun, right? It's gambling.
Yeah.
When you say you make a trade and that happens, the dopamine hit is insane. But the issue with it is you will get murdered every time you do that with no rules, right? You'll never become a profitable trader just operating off emotions because these markets will take you out. It's just a matter of time, right? And there are people that can do it and are good at it, but I'm telling you, for every crypto account that says they're making X dollars, there's 1% of them are, right? The others are just full of BS. But no, I think that's a very valuable point because there is such thing as a bad winning trade and a good losing trade.
Yeah, exactly. So let's wrap it up. Where the Crypto Flight Path has launched formally today, February 6th. It's Monday. We looked at some economic calendar data. We talked a little bit about the macro, a little bit about like what money is and how we're going to unpack some of those things in the future. And we'll do this again tomorrow. And we'll do some more chart analysis tomorrow. Talk a little bit more about like systems and system expectancy and how to maybe give some examples of how to set the risk reward thing here. I'm using TradingView, but just about any other platform that you use for charting might have the tools. Again, this is all just part of the toolkit, and how to look at charts and understand and go for try to form like an idea of like what the confluence of events are and what the higher probability move is based on what you can see um, as an individual, and then looking at analysis from third parties that may have better access to information than you or I. But anyway, anything else, Josh, you wanted to add for our inaugural episode here?
No, I think it was a great first episode. I think, what we're trying to do here is firstly educate people on crypto in general, educate you on the money system, and then also give you a series of tools to use these crypto markets to benefit financially from a short-term perspective and a long-term perspective. So partly, as we start this and as we kind of find our groove, this information will be presented in a more concise matter. What you'll probably notice is when we're starting out, we're going to try to feel out kind of our own path here and see if what resonates with viewers, and then also where we want to kind of focus our energy. But it'll be three or four things. It'll be the money system in general. It'll be trading to make an income. It'll be venture investing, and then it'll be crypto. Everything need to know about the crypto markets, from how to store crypto, different wallets, just general education on that. But that's our goal. I mean, did I miss anything there?
I don't think so. I think we're in good shape. So
Awesome. Well,
last
we'll
thing,
upload this to YouTube. Is that a pretty simple thing to do, Ted? Or
yeah,
do I do anything
yeah,
for that? If you can send me this, I can do it, and then
yeah,
we'll
we'll get it
upload
done.
it to Facebook too. And that way, if you didn't catch the live stream, you can watch it on YouTube. And we're going to try to be really consistent with this. So over time, I know these charts look intimidating. They're not. Once you kind of get into it, it all starts to make sense. And then the real money, the real magic in all this is having someone like Ted who can walk you through how to execute and how to define your risk. Because it's one thing to be able to read a chart, it's another thing to actually put on the trade and execute the trade. So we're all going to benefit greatly from his experience, and very happy that he's decided to share that with us and learn. So
My
uh,
pleasure.
that being said, congrats on the first show.
Yeah. All right. Well, thanks. Thanks for everyone who joined, meaning you and I, and to anyone that watches this moving forward. Put the feedback in the if this is on YouTube, drop us a comment, and we'll see you in the next one.
All right, man. Have a good one.
See you.